Greetings from 3Edge Asset Management. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3Edge. And I'm joined here today by Steve Cucchiaro, the President and Chief Investment Officer at 3Edge. Steve and I are creating this short video, and we have created others in the past few weeks. We're creating this video to give a look back at the week that was. It was a very significant week in the global capital markets. And we've talked to our clients throughout this period, and there are three questions that keep coming up. And so I'm going to pose those to Steve. First question talks to, well, the market's declined a significant amount here. Could it just keep going down? Another thing I'm going to ask Steve about is gold. Gold is a pretty good hedge for equities oftentimes, but it's struggled during this period. And thirdly, is this the time to get back in, or do we need to wait? So those are the three questions, and I'll start with the first one, Steve. So the first question is, yes, the market's gone down a lot. Could basically the bottom just fall out of this thing?
Well, to have a perspective on that, Fritz, it's good to look at similar situations in the past, but also to understand what were the driving forces behind the market decline. And it's not just the stock market that fell precipitously. Corporate bond market has had a shocking drop, and the commodities market has fallen tremendously. So all three major asset classes have all fallen. Rather than just focus on the coronavirus, which most people are, if you go back to before this all happened, we wrote a brief paper called The Next Bear Market. We didn't know that the coronavirus was going to hit so hard, certainly, but on February 11th, we published a paper that showed why we thought a bear market was possible, and maybe in the not too distant future, because the market was so overvalued, not just US stocks, but also corporate bonds. And that paper is available on our website, or people can request from anyone at 3Edge to receive a copy via email. So thinking about, can the bottom fall out even more? Some people think we were at fair value, and then we had this near 30% decline. This has to be the end. Our view is different. Our view is that the market was seriously overvalued before this market decline happened. We're now just getting back close to fair value. In fact, we're still slightly above where we calculated fair value might be. So that's one perspective to have. Secondly, all bear markets have certain characteristics that are similar. We've studied all the bear markets since the late 1800s. First, there's a sudden drop in value. We saw that in 1929, we saw that in 1987, we saw that in 2000, we saw that in 2008. And you have a first phase, which is the sudden drop. And then the second phase is the relief rally. And that usually starts with government intervention, either massive government fiscal spending or the central banks, the Federal Reserve Board, coming in with monetary stimulus. And we saw that in the Great Depression, although not to a good enough degree. We certainly saw it to a major degree in the financial crisis of 2008, when both the government and the Federal Reserve Board came in with unprecedented stimulus. And we know that there's going to be an attempt to do that very soon. Then finally, you get the third phase, which I would call the reality check. And if the government intervention was insufficient and the economy continues to deteriorate, then the bottom that you thought you had was a false bottom, and you continue to go lower. If the underlying situation improves, then that can prove to be the true bottom. So now, bringing it back to today, we have a situation where the stock market in the US fell nearly 30%. In the worst part of the crisis in 2008, we had a drop that went peak to trough over 50%, but it didn't happen all at once. There were these relief rallies. In the 1929 experience, we had a drop that was only slightly more than where we are today. And then we had a relief rally that lasted a few months. And then we had a much more precipitous decline after that. So one optimistic scenario would be that we are getting close to the point where the stocks begin to have at least a temporary bottom. Even in 1917, when we had the Spanish flu, which was the last global pandemic, stocks dropped 33%, not much more than they are today. So if in the next few days or sometime before the end of the month, we have a massive government stimulus plan, and I know Congress and the administration are negotiating that. If We have massive new programs from the Federal Reserve Board. We could look back and say, we're at the point where we have a temporary bottom. We could see a relief rally. Some people will say, everything's fine, get back in the market, this is a great bargain. Those are the people who think we were at fair value when the stock market was much higher. We won't think that, but we could see a temporary bottom.
Great. Okay, so then my next question is about gold. We all hold position in gold. It serves as a very good hedge against declines in the equity markets. Interestingly, since the high in equities in mid-February, gold has done much better than the equity markets, but it has seemed to struggle a bit in here. So how do we think about that, how gold has performed, and what do we think about how gold may perform going forward from here?
Well, one way to guide ourselves to understand what might happen next in the gold market is to think about what is driving this first major phase of this sharp downturn in the market. And what it is that it's been so sudden, it's been so steep. So many investors, so many hedge funds, so many personal investors went out and borrowed money to put more money in the stock market because it seemed like it would never go down. They over leveraged. And now that the stock market is coming down, they are forced sellers. So I would call this first phase forced liquidation. It's not just the US, but all over the world where people were too long equities, people borrowed too much money. Companies borrowed record amounts of money and used it for stock buybacks. And now all the collateral that's behind these loans, the prices of all that collateral are plunging. And so all of a sudden the loans are getting called, margin calls. And so investors are forced to sell. Whatever the price is, their loans are being called. So with this forced selling, there's a huge demand for cash. Everyone's trying to sell whatever they can, whether it's made money, lost money, sell whatever you have because they're forced to sell and they need to raise cash. And that's not just stocks. That also has included corporate bonds, and corporate bonds have had a surprising drop in value. And it's included gold. And gold is one of the few asset classes that were making money until recently. And even gold had to be sold to make these margin calls. Now, we had a similar experience in 2008 where the crisis happened. People were so surprised that gold initially went down, but it was a lot of that forced selling. And then once the central bank, the Federal Reserve Board, came in with big monetary stimulus, gold soared. And in a 3-year period, gold went up 166%. We think the Federal Reserve Board is going to have to come in an even bigger way because we're going to have an even sharper economic decline. And we believe that while gold is suffering in the short term because people are forced to sell, when the Federal Reserve Board acts to weaken the dollar, because a strong dollar will continue this financial tightening, they might end up having to print so much money to backstop the government and all the new debt that's going to be created with the fiscal stimulus that gold might soar to new records.
Great. So my third question, and I think you touched on it a wee bit earlier, but we do talk about the way that we manage portfolios is to invest in undervalued asset classes. We believed that U.S. equity markets in particular were overvalued. So have we reached the point of undervaluation? When will we be in a position to start to put money to work at more attractive levels?
Well, Fritz, you're absolutely correct that despite the temptation to invest aggressively last year, we stuck to our discipline. We held to our view that both U.S. stocks and corporate bonds were overvalued, even though the central way that many people invested was to put their portfolio maybe 60% U.S. stocks, 60% corporate bonds. We thought we had twin bubbles in both, and now that's come home to roost. And we've seen big declines in the stock and bond market, and we're so pleased that in the bond market we stuck with the treasuries. In the stock market, we had low allocation. So now, what do we think about? Are we near a bargain price? Are we near an undervalued asset class? So our view is that the U.S. stock market has gone from seriously overvalued to now just slightly overvalued. We do not think it's a screaming bargain. It doesn't mean we can't have a nice relief rally. It doesn't mean other people might not think it's a screaming bargain and might drive prices a bit higher from here. We do not think it's a screaming bargain. But I want to outline some interesting facts because the market has taken down many, many asset classes. So for instance, the U.S. stock market has fallen almost 30%, and now we're back to 2017 levels. So 3 years ago. Emerging market stocks have also fallen, but they were not overvalued particularly to begin with.
Right.
Emerging market prices are now back to 2006 levels.
Right.
Germany has fallen so sharply, even more sharply than the US stock market. The German price index is now back to 1999 levels, the MSCI Germany index. Commodities have been hit so hard between the oil price war and the economic shock that's about to begin.
Right.
Commodity prices are down to 1996 levels. And then finally, Japan, which we deemed as undervalued before this hit, is now down to 1986 levels. So we are looking hard. We're not anxious to go fully invested here. We think there's still plenty of downside, but we're looking very hard at where the next bargains might be. So in equities, we don't want to ignore some of the international markets that are now seriously undervalued.
Yeah.
We still want to wait for catalysts to show that they're safe to invest again. But that's where we might find more bargains. Also with commodities, it would be hard to want to invest strongly in commodities when the global economy is about ready to enter a serious recession.
Right.
But there will be some point where there will be bargain commodity price, especially since commodity prices are priced in dollars and the Fed might print so many dollars that those prices look attractive. And then finally with bonds, credit spreads have widened, and we've warned people away from corporate bonds because we said credit spreads were too narrow.
Mm-hmm.
And people were tempted to buy corporate bonds, just get a little extra yield over the treasuries. And we said that they weren't being rewarded for the risk. Now it's shown that, yes, they were a lot riskier than people thought because now we have an economic decline. There may be a point where those credit spreads widen so much, like in 2008, that those could be attractive for you.
Great. Great. Well, Steve, thank you very much for all of your insights there. And on behalf of our firm, we wish everybody stay strong and be safe. And thank you for listening. And thanks again, Steve.
Thank you all.